The silver market just did something it hasn't done in over 40 years. While everyone's distracted by holiday shopping and year-end portfolios, silver quietly crossed a threshold that changes everything. And I mean everything. Right now, as I'm recording this, silver is trading above $66 per ounce. Let me put that in perspective. At the start of this year, silver was around $24. That's a 175% gain. Gold, by comparison, is up about 27%. The S&P 500, roughly 23%. Silver didn't just outperform, it obliterated every other major asset class. But here's what's really happening beneath the surface, and why this isn't some temporary spike that's going to fade away. The physical silver market is breaking. Not bending. Breaking. And when I say breaking, I mean the fundamental structure that's kept silver prices suppressed for decades is coming apart at the seams. Let me walk you through what's actually occurring right now in the silver market, because the mainstream financial media is either missing it completely or deliberately ignoring it. First, understand that silver trades in two completely different markets. There's the paper market, the COMEX futures, the ETFs, the derivatives, where banks and institutions trade contracts representing silver. Then there's the physical market, actual bars and coins that you can hold in your hand. For years, these two markets moved together. The paper price dictated the physical price. If COMEX said silver was worth $20, then physical silver cost $20 plus a small premium. That relationship just shattered. Physical silver premiums have exploded. Dealers are paying $4 to $6 over spot just to acquire inventory. Some are paying even more. Delivery times have stretched from days to weeks, and in some cases, months. The U.S. Mint can't keep up with demand for silver eagles. They're rationing supply to authorized dealers. This is the same pattern we saw in 2008, right before silver went from $9 to $49 in less than 3 years. But this time, the underlying fundamentals are exponentially more extreme. Let's talk about supply and demand, because this is where the story gets really interesting. Silver mine production peaked in 2016 at about 900 million ounces. Since then, it's been declining. We're now producing roughly 830 million ounces annually from primary silver mines. And here's the kicker. There are virtually no new major silver deposits being developed. The lead time to bring a new silver mine online is 10 to 15 years. Even if companies started aggressive exploration today, we wouldn't see meaningful new supply until the late 2030s. Meanwhile, demand is accelerating in ways we've never seen before. Industrial demand for silver is at all-time highs and climbing. Solar panels alone consumed over 200 million ounces this year. Every solar panel requires about 20 grams of silver. As countries race to meet climate goals and energy independence, solar installations are projected to double, then triple. That's not speculation. Those are contracted projects already in the pipeline. Electric vehicles use twice as much silver as traditional cars. Every EV contains roughly 25 to 50 grams of silver in various components. Global EV sales are growing at 35% annually. Do the math on what that means for silver demand over the next 5 years. 5G infrastructure requires significantly more silver than 4G. Each 5G base station uses about 1 kilogram of silver. There are plans to install millions of these stations globally. China alone is targeting 5 million 5G base stations. Then you have traditional industrial uses, electronics, medical devices, water purification, mirrors, batteries, bearings. Silver is in everything. And unlike gold, which gets recycled at high rates, most industrial silver is consumed. It's used in such small quantities per application that it's not economically viable to recover. Once it's gone, it's gone. Now layer on investment demand. Central banks, which have been net sellers of silver for decades, are now net buyers. Not in huge quantities yet, but the trend has reversed. When central banks change direction, it's not a short-term trade. It's a strategic shift. Institutional investors are finally waking up to silver. For years, they ignored it. Too volatile, too small, too industrial. But when you're managing billions and looking for assets that can preserve purchasing power in an inflationary environment, silver suddenly looks very attractive, especially when it's historically cheap relative to gold. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has been a reliable indicator for centuries. The historical average is around 15 to 1. During the 1980 silver peak, it briefly hit 17 to 1. In 2011, it was 31 to 1. Right now, even with silver at $66, the ratio is still around 40 to 1. If silver simply returned to its historical relationship with gold, we're looking at $140 to $180 per ounce. And that's assuming gold stays where it is. But here's where it gets really interesting. Let's talk about what's happening in the derivatives market. The COMEX, the Chicago Mercantile Exchange where silver futures trade, has a problem. A big problem. The amount of paper silver traded on the COMEX dwarfs the amount of physical silver actually available for delivery. On any given day, the COMEX might trade 500 million ounces of paper silver, but the registered inventory, the silver actually available for delivery, is around 50 million ounces. That's a 10 to 1 ratio, and it's been shrinking. What happens when more people start demanding physical delivery instead of just rolling their contracts forward? The system breaks. We're starting to see early signs of stress. Large institutional players are taking delivery, not closing positions, actually taking the metal. When that happens, it comes out of registered inventory and moves to eligible inventory, which means it's no longer available for delivery against futures contracts. This creates a squeeze. As registered inventory drops, the remaining silver becomes more valuable. Premiums rise. Delivery delays increase. Eventually, you reach a point where the paper price and the physical price completely disconnect. We saw this happen in nickel in 2022. The London Metal Exchange had to halt trading and cancel trades because the physical market couldn't support the paper positions. It was a disaster, and nickel is a far larger, more liquid market than silver. Now, let me connect this to something most people aren't paying attention to: the geopolitical dimension. China has been accumulating silver quietly for years. Not through official channels that get reported, through private purchases, through Hong Kong, through intermediaries. Why? Because silver is strategic. It's essential for military applications, for advanced electronics, for the technologies that define modern warfare and economic competition. Russia has been doing the same thing. After sanctions cut them off from dollar-based financial systems, they've been stockpiling physical commodities: gold, silver, platinum, palladium, real assets that can't be frozen or seized. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the new members, are actively working to reduce dollar dependence. Part of that strategy involves accumulating hard assets. Silver is on that list. When major nations start competing for a finite resource, prices don't just rise gradually, they spike hard. Here's a historical parallel that should concern anyone not positioned in silver right now. In 1971, Nixon closed the gold window. The dollar was no longer convertible to gold. What happened next? Gold went from $35 to $850 over the next 9 years. Silver went from $1.50 to $50. But here's what most people forget. The real move happened in the final 18 months. Silver went from $6 to $50 in less than 2 years. We're potentially in the early stages of a similar move right now. The difference is, the fundamentals are far more extreme this time. In 1980, there were billions of ounces of above-ground silver inventory. Today, there's less than 2 billion ounces of investment-grade silver in the entire world, and a significant portion of that is held by people who have no intention of selling. The U.S. government used to hold a strategic silver stockpile. They sold it all. It's gone. The Hunt brothers tried to corner the silver market in 1980 with about 200 million ounces. Today, that amount of silver represents less than 3 months of global industrial demand. The market is smaller, tighter, and more vulnerable to disruption than ever before. Now, if you're sitting on retirement accounts, IRAs, 401ks, traditional portfolios, you need to understand something critical. The wealth you've accumulated is denominated in dollars, and dollars are losing purchasing power at an accelerating rate. Official inflation numbers say 3 to 4%. But anyone buying groceries, paying insurance, or covering healthcare costs knows the real number is much higher. Your retirement savings are being quietly eroded. Quick aside here. If you have $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs work. It's completely free, link is in the description. It covers how you can get physical precious metals into your retirement account without triggering tax penalties or early withdrawal fees. It's worth looking at if you're concerned about protecting your purchasing power. I'll get back to the silver analysis in just a moment. So where does silver go from here? Let's look at the technical picture and the fundamental drivers. Technically, silver just broke through major resistance levels that have held for years. The $30 level was significant resistance. Silver blew through it. The $50 level from 2011 is the next major psychological barrier. At the current rate of ascent, we could test that level within months. But the real question isn't whether silver hits $50. It's what happens after it breaks through $50, because that's when the psychology shifts completely. Right now, most investors still view silver as a speculative commodity, something you trade, not something you own for the long term. When silver breaks its all-time high and starts making new records, that perception changes. It becomes a momentum play. Money flows in from everywhere. Hedge funds that have been short silver will be forced to cover. That creates buying pressure. Retail investors who missed the move from $24 to $66 will FOMO in at $75, $100, $125s. Institutional allocators who need to show they're positioned in the hottest asset class will add silver exposure. This is how parabolic moves happen, not because of fundamentals alone, but because of the feedback loop between rising prices, changing psychology, and forced positioning. The supply deficit is real and growing. This year, the silver market is short by roughly 200 million ounces. That deficit has to be filled from above-ground inventory. But that inventory is finite and shrinking. At some point, and we may be approaching it now, the market realizes there simply isn't enough silver to meet demand at current prices. That's when price discovery becomes violent. Let me give you a specific example of what this looks like in practice. In 2021, a group of retail investors on Reddit decided to buy physical silver to expose the paper manipulation. They called it the silver squeeze. Millions of people tried to buy physical silver simultaneously. Dealers sold out within hours. Premiums spiked to $10 over spot. The U.S. Mint couldn't produce enough coins. COMEX registered inventory dropped by 30% in a matter of weeks. And that was just retail investors with relatively small amounts of capital. Imagine what happens when institutional money, pension funds, sovereign wealth funds, family offices managing billions, decides they need silver exposure. The market can't absorb that kind of demand without massive price increases. It's simple math. There isn't enough physical silver available at anywhere near current prices to satisfy institutional scale demand. Now let's talk about the elephant in the room: market manipulation. For years, silver investors have claimed the market is manipulated. Banks have been fined for spoofing and manipulation. J.P. Morgan paid nearly $1 billion in fines for manipulating precious metals markets. This isn't conspiracy theory. It's documented fact. The question is, can they continue to suppress prices in the face of overwhelming physical demand? The answer appears to be no. When physical demand exceeds available supply, paper manipulation becomes irrelevant. You can't deliver paper contracts. You can't manufacture physical silver out of thin air. The laws of supply and demand ultimately win. We're watching that play out in real time. The paper price is being dragged higher by physical market realities, and the gap between paper and physical is widening, which means the paper market is losing control. Here's what happens next, based on historical precedent and current market structure. Phase 1, we're in it now, is the breakout phase. Silver breaks through major resistance, gains momentum, attracts attention. Premiums rise, availability tightens, but physical silver is still obtainable if you're willing to pay up and wait. Phase 2 is the acceleration phase. This is when the move goes parabolic. Silver gains $5, $10, $15 in a single week. Mainstream media starts covering it. Your neighbors start asking about silver. Dealers can't keep inventory. Premiums explode to $15, $20 over spot. Phase 3 is the mania phase. This is when silver becomes a cultural phenomenon. Everyone wants it. Prices become disconnected from any rational valuation. Silver hits $100, $150, $200. People are buying at any price because they're convinced it's going higher. Phase 4 is the crash. It always crashes. parabolic moves always end badly. But here's the key. The crash usually takes silver back to levels that are still multiples higher than where it started. In 1980, silver crashed from $50 to $10, but $10 was still 6x higher than where it started the bull run. In 2011, silver crashed from $49 to $26, but $26 was still 5x higher than the 2008 lows. The strategy isn't to ride it all the way up and all the way down. The strategy is to accumulate physical silver now, while it's still available, and have a plan for taking profits as the move matures. But here's what's different this time. The fundamental supply deficit is real and structural. It's not going away. Even after a speculative blow-off top, silver will likely settle at levels far above where we are today, because industrial demand isn't going away. Solar panels still need silver. EVs still need silver. 5G still needs silver. The world is becoming more electrified, more connected, more dependent on technologies that require silver. That's not a temporary trend. That's the direction of civilization. So, when people ask, is silver in a bubble? The answer is no, not yet. Bubbles happen when prices become completely disconnected from fundamentals and everyone is involved. We're not there. Most people still don't own any silver. Most financial advisors still don't recommend it. Most institutions still don't have meaningful exposure. When your dentist is telling you about his silver position, when CNBC is running 24/7 silver coverage, when silver ETFs are seeing billions in daily inflows, that's when you know we're in bubble territory. We're nowhere close to that yet. What we're seeing now is the early stage of a fundamental repricing. Silver was undervalued for decades. The market is correcting that mispricing. How far does the correction go? Nobody knows. But based on historical precedent, supply-demand fundamentals, and monetary conditions, 100+ of silver is not only possible, it's probable. The question you need to ask yourself is this: what percentage of your wealth is positioned to benefit from this move? If the answer is 0 or close to 0, you're taking on enormous risk. Not the risk of silver going down, the risk of missing one of the most significant wealth transfers in modern financial history. Because here's the reality. When silver moves, it moves fast. You won't have time to research, to deliberate, to wait for a pullback. By the time it's obvious to everyone, the easy gains are gone. The people who make life-changing returns in markets like this are the ones who position early, when it's still uncomfortable, when most people think they're crazy. They're the ones who understand the fundamentals, recognize the setup, and have the conviction to act. Right now, you can still buy physical silver. It might take a few weeks to get delivered. You might pay a $5 premium over spot, but you can get it. 6 months from now, that might not be true. The premium might be $20. Delivery might take 6 months, or it might not be available at any price. This isn't fear-mongering. This is pattern recognition based on how these markets work when supply-demand imbalances reach critical levels. The silver market is sending a signal, a very loud, very clear signal. The question is whether you're paying attention. Everything I've laid out here, the supply deficit, the industrial demand growth, the geopolitical accumulation, the technical breakout, the derivatives stress, the historical parallels, all of it points in the same direction. Silver is repricing, not because of speculation, not because of manipulation, because the fundamental reality of supply and demand has shifted, and prices have to adjust to reflect that new reality. The move from $24 to $66 isn't the end, it's the beginning, and what comes next is going to be far more dramatic than what we've seen so far. So here's my challenge to you. Don't take my word for any of this. Do your own research, look at the supply-demand data, study the historical precedents, understand the market structure, then make your own decision about whether silver deserves a place in your portfolio. But do it now, because the window of opportunity to position at reasonable prices is closing. And once it closes, it won't reopen until after the move is over. The silver market just gave you a wake-up call. The only question is whether you're going to answer it.